If you have ever felt that money disappears faster than it should, you are not imagining it. There is a reason. And the reason is not only that you spend too much, it is that the system around your paycheck is moving against you. Food moves, interest rates move, rent moves, insurance moves, debt costs move, the price of ordinary life moves, but most paychecks do not move fast enough. That is the pressure people feel every month. They work, they earn, they try to be responsible, they avoid obvious waste. And still, the money seems to vanish. This is why people often think small investing is pointless. They look at $35 a week and say, what difference can that possibly make? They are measuring the habit with the wrong ruler. $35 in 1 week is small. $35 repeated every week for decades is a different object. Time changes the meaning of money. That is one of the central principles of investing. Time works against your paycheck when inflation is rising faster than wages. But time can work for your investments when you own productive assets and allow compounding to operate. That is the connection most people do not see. The same force that makes your grocery bill more expensive can also make asset ownership more important. If the cost of living compounds against you, then you need something compounding for you. That is the entire reason weekly investing matters. Not because $35 feels large, not because one weekly deposit will change your life, but because a small repeated action, tied to ownership and time, can become larger than the labor income people thought would always carry them. Most people underestimate small actions because they judge them too early. They put in $20 and see almost nothing. They put in $35 and see almost nothing. They check the account a month later and say, this is not working. That is because the first stage of compounding almost always looks unimpressive. The early phase is quiet. The money is not yet large enough to produce visible movement. The portfolio has not yet built enough mass. The snowball has not yet reached the hill, but the process has already started. That is the part that matters. I want you to think of a paycheck and an investment portfolio as two very different machines. A paycheck is linear. You work an hour, you receive compensation. You work another hour, you receive more compensation. The relationship is direct. It depends on your time, your labor, your employer, your skill, and the market for your work. An investment portfolio is different. A portfolio can grow while you sleep. It can pay dividends while you are doing something else. It can reinvest those dividends into more ownership. It can benefit from thousands of companies trying to raise revenue, improve margins, build products, and earn profits. That is not linear, that is compounding. And when compounding has enough time, it can begin to outrun linear labor. That is what people mean when they say a small weekly investment can eventually produce more income than many full-time jobs. It sounds impossible at first, but it becomes possible because the portfolio is not only built from your deposits, it is built from returns on deposits, dividends on shares, reinvestment of dividends, growth of companies, and growth on prior growth. That is a very different machine. Now, to understand why the investment machine matters, first look at the environment working against the paycheck. Food prices have climbed sharply since 2020. The source document lays out the yearly pressure clearly. Food prices rose around 3.5%, then nearly 4%, then almost 10% in 2022 before slowing to about 5.8% in 2023, around 2.3% in 2024, and about 2.5% in 2025. The exact feeling of this is simple. What costs $20 in groceries in 2020 costs about $25.32 in 2025. That is not an abstract number. People feel it in the store. They feel it when the same cart costs more. They feel it when a basic meal becomes less basic. They feel it when the paycheck is the same, but the refrigerator costs more to fill. Then look at debt. Interest rates moved from near zero in 2020 to around 4% by late 2025, according to the source document S use of Federal Reserve data. That makes mortgages heavier, car loans heavier, credit cards heavier, business loans heavier. Everything financed with borrowed money becomes more expensive. So while food is rising, the cost of borrowing is also rising. That means the household is squeezed from two sides. Everyday expenses rise, debt service rises. Now look at wages. The source document says year-over-year pay growth was around 3.8% in 2025. That may sound acceptable for 1 year, but it does not fully repair the cumulative increase in prices since 2020. This is the trap. A wage increase can feel like progress in nominal terms while still failing to recover lost purchasing power. You earn more dollars, but the dollars buy less. That is what people feel. That is why many people are working harder and still feeling poorer. The system is not only about income, it is about purchasing power. If your income grows 3 or 4%, but the total cost of life has risen much more over several years, your real position can weaken. This is why relying only on wages is dangerous. The paycheck is necessary, but the paycheck alone may not be enough if assets are compounding faster than labor income. Now, this does not mean the stock market is smooth. It is not. The market has crashes, the Great Depression, the dot-com collapse, the 2008 financial crisis, the 2020 COVID crash, the inflation-driven decline in 2022. These are real events. They frighten people while they happen. They create headlines. They cause people to sell. They make disciplined investing feel foolish in the moment. But when you zoom out, the source document's point is clear. The market has eventually recovered from major crashes, and the long-term trend has moved upward. That is not a guarantee for the future. Nothing in markets is guaranteed, but it is an important historical pattern. Productive systems recover because companies adapt, consumers continue to need goods and services, innovation continues, and capital seeks productive uses. The line is not straight, but over long periods, ownership of productive assets has been powerful. Historical market return. Research often places long-term market returns around 10 to 11% per year, including dividends. Again, that is not a promise that every year will produce that return. It is an average across long periods with many bad years inside it. But if wages are growing around 3 to 4% and the broad market can compound much faster over long periods, the investment machine begins to separate itself from the paycheck machine. That separation is the point. Your paycheck can pay today. Bills, your investments can help build tomorrow. Income, if you never build the investment side, you remain dependent only on labor. If you build the investment side consistently, labor begins to produce capital, and capital begins to produce more capital. That is the transition. Weekly investing works because it does not require prediction. It does not ask you to know when inflation will fall. It does not ask you to know when the next crash will happen. It does not ask you to call the bottom. It does not ask you to wait for the perfect economic report every week. The money goes in. If prices rise, the money goes in. If prices fall, the money goes in. If the market is frightening, the money goes in. If the market is euphoric, the money goes in. That consistency removes one of the most dangerous variables in investing. Your emotions. Most people do not fail because they cannot understand the concept of investing. They fail because they cannot execute through fear and boredom. They pause when headlines are ugly. They delay when prices are falling. They wait for clarity. Then prices recover, and they feel they missed the opportunity. Then they chase. Then a correction comes. Then they panic. This cycle repeats because human beings are not naturally wired for compounding. They are wired for short-term survival. That is why automatic weekly investing is powerful. It creates a system that continues when the mind wants to interfere. A good system protects you from your worst impulses. Now, let us look at small weekly amounts. Suppose someone invests $20 every week. That is $1,040 per year. Most people hear that and dismiss it. They say $1,000 a year is not enough, but that is a linear reaction. In the first year, the account may not look dramatic. The contribution is $1,040 with normal market movement and reinvested dividends. The balance starts to move a little, nothing explosive. But the first layer of the snowball is forming. By year 3, total contributions reach $3,120. Because early deposits had time to grow and dividends were reinvested, the balance may be around $3,750. The difference between contributions and balance is the snowball beginning to show itself. By year 5, total contributions reach $5,200. The account may be closer to $6,850. Now, the extra growth is more visible, still not life-changing, but it is real. The important thing is that each new weekly deposit lands on a larger foundation, and every dividend buys more shares, which can produce more dividends later. The first 5 years do not look explosive because compounding is mostly building the base. That is exactly why most people quit too early. They expect the account to prove itself immediately. But compounding does not work to impress you in the first year. It works by accumulating ownership until the base is large enough for the curve to bend. That is the snowball effect. The first snow is not impressive. The rolling is what matters. Now, the mindset behind weekly investing is just as important as the math. Most people struggle not because weekly investing is complicated. It is not complicated. They struggle because the early results feel too small. You put in $20, you look at the balance, nothing dramatic happened. Your brain wants fast feedback. It wants a clear reward. It wants proof. But compounding gives delayed proof. That is why the better question is not, is this growing fast enough? This week, the better question is, did I invest this week? That shift matters. It moves attention from outcome to process. You cannot control next week's market return. You can control whether you invest. You cannot control inflation. You can control consistency. You cannot control the Federal Reserve. You can control the habit. You cannot control whether the market corrects next month. You can control whether you keep buying through it. When the measure of success becomes consistency, investing becomes much easier psychologically. You stop judging a long-term machine with a short-term stopwatch. That is how people stay with the plan. Now, once the mindset is correct, the next question is what to own. Most beginners search for the perfect fund, the perfect stock, or the one magic investment that solves everything. That is not the best way to think. A portfolio does not need perfection. It needs structure, it needs diversification, it needs exposure, it needs low fees, it needs historical durability, it needs income growth, it needs a design that lets the investor stay invested for decades. Start with diversification. Diversification means not depending on one company to carry your future. If a portfolio owns hundreds or thousands of companies, one failure does not destroy the system. A company can disappoint, another can outperform, a sector can weaken, another can lead. The whole portfolio keeps moving because the investor owns the broader engine. This is why index funds can be powerful. They eliminate the need to choose one winner. They allow you to own the productive system. Next is broad exposure. Exposure is different from diversification. Diversification asks how many companies you own. Exposure asks what kinds of companies you own. Large companies, mid-sized companies, small companies, growth companies, income companies, sustainable companies, different sectors, different styles, markets rotate, some years large caps lead, some years mid caps perform better, some years growth dominates, some years income and value matter more. A portfolio with broader exposure has more ways to participate. Next is real historical performance. You do not want to build a long-term plan on pure hype. You want funds that own companies with evidence of growth, earnings, dividends, and survival through cycles. Past performance does not guarantee future performance, but history still gives information. It shows whether the fund's underlying exposure has been able to compound through different environments. Next is dividend growth. Dividends matter not only because they pay cash. They matter because reinvested dividends buy more ownership. When dividends grow over time, the compounding loop can become stronger. The portfolio owns more shares. Those shares pay dividends. Those dividends buy more shares. Those additional shares pay more dividends. This is a repeating cycle over decades. It can become very powerful. Finally, low fees matter. Fees look small in 1 year. They become large over decades. A tiny fee difference can remove thousands of dollars of future wealth from the compounding machine. Low fee and zero fee funds keep more of the return working for the investor. That is why the funds in the source portfolio matter. They are not chosen because they are exciting. They are chosen because they each serve a role. Now let us walk through the 5 Fidelity funds used in the source document. The first is FZROX, the Fidelity Zero Total Market Index Fund. This is the core. It owns large, mid, and small cap companies across the U.S. market. Its purpose is simple. Give broad exposure to the entire U.S. stock market with zero management fees. That makes it a strong foundation. The source document lists a yield of 1.04%, dividend growth of 7.55% per year, and annual price appreciation of 13.5%. The numbers may change over time, but the role is clear. FZROX is the broad market engine. It gives the portfolio a base tied to the overall productivity of American business. The second is FSMDX. The Fidelity Mid-Cap Index Fund. This fund focuses on mid-sized companies. Mid-caps can be interesting because they sit between the stability of large companies and the growth potential of smaller companies. They are often more established than small caps but still have more room to grow than mega-cap companies. The source document describes the fund as holding around 300 companies across technology, industrials, consumer sectors, and finance. It lists a yield of 2.42%, dividend growth of 17.21%, and annual appreciation of 7.4%. The role is expansion. FSMDX adds companies that are still climbing. The third is FITLX, the Fidelity U.S. Sustainability Index Fund. This fund gives the portfolio a more modern tilt. It screens for companies with environmental, social, and governance characteristics, and includes many leaders in technology, healthcare, communications, and other forward-looking sectors. The source document lists a yield of 1.14%, dividend growth of 13.74%, and annual appreciation of 13.06%. The role is future-oriented growth and resilience. It brings exposure to companies shaping modern markets. The fourth is FGRIX, the Fidelity Growth and Income Portfolio. This fund is meant to bring balance. It focuses largely on high-quality, large-cap companies with stable earnings. reliable dividends, and growth potential. A portfolio that only chases growth can become too volatile. A portfolio that only chases yield can become too slow. Growth and income tries to combine both. The source document lists a yield of 3.13%, dividend growth of 19.68%, and annual appreciation of 8.17%. Its role is to lift both sides of the system, income and growth. The fifth is FDGFX, the Fidelity Dividend Growth Fund. This fund is the income stabilizer. It focuses on companies with histories of raising dividends and strong fundamentals. It is not there to be the most aggressive racer. It is there to strengthen the portfolio's income compounding over time. The source document lists a yield of 3.2%, dividend growth of 18.03%, and annual appreciation of 2.78%. Its role is stability through dividend growth together. These five funds create a simple system: one broad total market engine, one mid-cap expansion engine, one sustainability and future growth tilt, one growth and income balancer, one dividend growth stabilizer. This is not a perfect portfolio for every person. No portfolio is perfect for every person, but the structure is understandable. And an understandable portfolio is easier to hold. That matters. A portfolio you cannot understand is a portfolio you are more likely to abandon during stress. Now, the source document calculates the portfolio averages using an equal weighted approach. That means each fund is treated as 1/5 of the portfolio. For dividend yield, the yields are added together: FRAX at 1.04%, FSMDX at 2.42%, FITLX at 1.14%, FGRIX at 3.13%, FDGFX at 3.2%. The total is 10.93% divided by 5. The average yield is about 2.19%. That is the starting income yield. Then the same averaging process is used for dividend growth and price appreciation. The source document gives an average dividend growth rate of 15.24% and an average annual share price appreciation of 8.98% together. Those numbers describe the engine. The portfolio can grow in price. It can also grow its income over time. That combination is important. A portfolio that only appreciates may make the investor dependent on selling shares for income. A portfolio with growing dividends can begin producing a rising income stream. If those dividends are reinvested during accumulation, they buy more shares and strengthen future income. This is why reinvestment matters so much. Dividends taken out and spent stop compounding. Dividends reinvested become more ownership, and more ownership can create more future dividends. That is the loop. Now, let us use the source example. Josh invests $5 per Dalton Y. That equals $35 per week, because the portfolio has 5 funds. It is roughly like putting $1 per Dalton Y into each fund. This sounds tiny. It is the kind of money many people spend without noticing: a coffee, a snack, an app, a small convenience, a forgotten subscription. But directed into a long-term investment system, that tiny amount becomes meaningful because it is repeated. At the end of year 1, Josh has contributed about $1,825. This lays the foundation. It does not yet produce wealth. It creates the base. By year 10, with reinvested dividends and compounding, the portfolio is projected in the source document to reach about $32,000. That is where the habit begins to show itself. Still not retirement money. But now the account is real. By year 20, Josh has contributed $36,500 out of pocket. The portfolio is projected to reach around $160,000 at that stage. It may generate nearly $9,000 per year in dividends. Think about that. The annual dividend income alone begins to resemble an amount larger than several years of original annual contributions. The portfolio is no longer only receiving money. It is starting to produce money. Then the final decade shows the power of compounding. By year 30, the portfolio is projected in the source document to reach about $942,000. It is projected to pay around $98,000 per year in dividends. That is about $8,000 per month. The source document then breaks down the total contributions over 30 years. Josh contributed about $54,750 from his own pocket. The portfolio grew to about $942,000. Subtract contributions from the ending value, and about $887,250 came from compounding, reinvested dividends, and long-term market growth. That is the central point. Most of the future wealth did not come from Josh's raw deposits. It came from the machine that the deposits built. The habit was small. The machine became large. That is how small weekly investing can eventually surpass the income of many full-time jobs. Not in year 1, not in year 5, not because $35 is a lot, because $35 repeated with discipline over long periods becomes ownership, and ownership compounds. Now, I want to be careful. Projections are not guarantees. A portfolio does not move in a perfect smooth line. The funds will change, the yields will change, dividend growth will change, market returns will change, there will be bad years, there will be recessions, there will be crashes, there will be periods where the portfolio appears to go nowhere. There will be years when contributions seem to disappear into market declines. But the discipline is built for exactly that kind of world. If prices decline, weekly contributions buy more shares. If dividends are reinvested, more shares are accumulated. If the market recovers, the investor benefits from the ownership built during the downturn. This is why dollar-cost averaging works psychologically. It keeps you from trying to be a perfect forecaster. Perfect forecasting is not available to most people. But consistent participation is the practical edge. Most people think the advantage belongs to the person who predicts the market. In reality, the ordinary investor's advantage often comes from not needing to predict. The disciplined weekly investor does not need to know which month is the bottom. The money goes in anyway. The disciplined investor does not need to know whether inflation is peaking. The money goes in anyway. The disciplined investor does not need to know whether the Fed will cut next quarter. The money goes in anyway. This is not ignorance. It is humility. It recognizes that the future is unknowable and builds a process that can operate anyway. Now, why is weekly investing sometimes better than one-time investing in the real world? Mathematically, if you have a lump sum and markets rise over time, investing sooner often has an advantage. But most people do not have a large lump sum. They earn income over time. They save from paychecks. They must invest from cash flow. Weekly investing matches the way most people actually receive and spend money. It turns investing into a recurring bill to your future self. And because it happens frequently, it reduces the emotional drama of market timing. A large one-time investment can feel scary. What if the market drops next week? What if you bought the top? What if a recession comes? Weekly investing softens that fear because you are not betting everything on one date. You are spreading entry points across many dates. That makes the process easier to sustain. And in investing, the process you can sustain usually matters more than the process that looks optimal on a spreadsheet but fails emotionally. Now, the other reason weekly investing is powerful is identity. A person who invests weekly becomes an investor by repetition, not by intention, not by talk, by behavior. Every week, the person proves, I am the kind of person who buys assets. That identity matters. People who only think about investing remain consumers. People who repeatedly buy ownership become capital allocators. Even if the amount is small, the habit changes the self-image. That is how long-term behavior is built. A person who invests $5 per Dalton Y learns to prioritize assets over impulses. That is a subtle but powerful change. Now let us compare this with wages. A paycheck is important. You need income. You need earned cash flow. The portfolio begins with money earned from labor. So it is wrong to disrespect wages. But wages have limits. You can only work so many hours. Your body has limits. Your job market has limits. Your employer has incentives. Your raise may not keep up with the true cost of living. Even if your pay rises, taxes and expenses can absorb much of the gain. An investment portfolio can eventually become a second worker. At first, it is a weak worker. It does almost nothing. Then it grows. Later, it can become a strong worker. At some point, the portfolio's annual growth and dividends can rival or exceed the amount you contribute. That is when the machine changes. Eventually, the portfolio may produce more income than a job. That is the destination. But the destination is not reached by staring at the portfolio. It is reached by feeding it consistently for years, especially when the early feedback is boring. Now, let us think about why low fees matter so much in this example. If two funds own similar assets but one charges higher fees, the higher fee removes a small piece of return every year in 1 year. That may not look dramatic. Over 30 years, the loss compounding can be large. This is why zero-fee and low-fee funds can be attractive for long-term investors. Every dollar not paid in fees remains inside the machine. That dollar can compound. This is one of the few variables investors can control. You cannot control market returns. You cannot control inflation. You cannot control the Federal Reserve. You cannot control whether a recession happens. But you can control fees, you can control consistency, you can control diversification, you can control whether dividends are reinvested, you can control whether you panic sell. Those are the levers. Focus on controllable levers. Now let us think about dividend growth. A dividend yield of 2.19% may not sound exciting. But the yield is only the starting point. If the dividends grow over time and are reinvested, the income base can grow faster. This is why dividend growth matters more than static yield. A high yield that does not grow or is not sustainable can be dangerous. A moderate yield with strong growth can become powerful. In the source portfolio, the average dividend growth rate is calculated at 15.24%. That is an aggressive historical average and should not be assumed forever. But the principle remains: growing income plus reinvestment strengthens compounding. Income growth is not separate from wealth growth, it is part of the loop. Now, consider the emotional benefit of dividends. A market decline can scare investors because price falls are visible. Dividends can help psychologically because they show that the portfolio is still producing cash flow if reinvested. Those dividends buy more shares when prices are lower. That can make downturns feel more productive. The investor begins to see volatility not only as loss, but as a chance to accumulate more ownership. This is a healthier mindset. Now, we should also be honest about risk. A 5-fund Fidelity portfolio is still exposed to the stock market. It can decline, it can underperform. Dividend growth can slow, funds can change holdings, yields can fall, a portfolio projection can fail to match reality. If someone cannot tolerate volatility, they must adjust the strategy. Maybe they need cash reserves, maybe bonds, maybe a different allocation, maybe a slower growth expectation. The source portfolio is an equity-oriented compounding portfolio. It is not a savings account. It is not guaranteed income. It is not a promise of $8,000 per month. It is a projection based on assumptions. A disciplined investor always separates projection from guarantee. The projection shows what can happen if assumptions hold and behavior remains consistent. The plan must still survive if assumptions are worse. That is why the first layer of financial life should not be ignored. Emergency fund, no high-interest debt, stable cash flow insurance, where needed, then investing. If a person has credit card debt at 20%, $35 per week might need to attack that debt first. If a person has no emergency fund, some money may need to build cash. If a person cannot pay bills, investing cannot solve that immediately. Order matters. But once the foundation is reasonable, weekly investing becomes one of the simplest ways to build long-term capital. Now, let us look at the deeper principle behind the Fidelity portfolio. The portfolio is not trying to select one hero stock. It is trying to own parts of many productive businesses through funds. That is important. Most people are not equipped to pick individual winners consistently. They do not have time. They do not have research infrastructure. They do not have emotional discipline. They are influenced by headlines, social media, and recent performance. A diversified fund portfolio reduces the need to be brilliant. It does not eliminate risk, but it reduces single company risk. That is a major advantage for ordinary investors. In markets, not needing to be brilliant can be a superpower. A simple system executed for decades can outperform a complex system abandoned in year 3. That is why the portfolio should be simple enough to understand and repeat. Now let us examine each fund's role in the machine again from a systems perspective. FZROX is the core because it owns the broad U.S. market. It gives exposure to many sectors and company sizes. It is the foundation. FSMDX adds mid-cap growth potential. Mid-sized companies can be dynamic because they may still have room to grow but are not as fragile as very small companies. FITLX adds exposure to companies with sustainability characteristics and modern sector leadership. It brings a tilt toward companies that may be shaping future industries. FGRIX adds growth and income, combining established large companies with dividend and earning strength. FDGFX adds dividend growth stability, making the income compounding loop stronger. The portfolio is not random. Each piece plays a role. This is how I think about portfolio construction. Every asset should have a job. If you do not know the job, you may not know why you own it. And if you do not know why you own it, you may sell it at the wrong time. The fund's job helps you hold it. Now, one could argue about whether equal weighting is ideal. Maybe someone wants more in the broad market core and less in the specialized funds. Maybe someone wants less dividend focus and more growth. Maybe someone wants bonds. Maybe someone wants international exposure. Those are legitimate questions. The source document uses equal weighting for simplicity. That simplicity helps people understand the concept. But in real planning, allocation should match age, risk tolerance, goals, tax situation, and time horizon. A 25-year-old may hold more equities. A 60-year-old may need more stability. A high-income investor in a taxable account may think differently from someone using a Roth IRA. The concept is stable. but the implementation can vary. Now, what should someone do with the $35 per week? The simplest method is automation. Set a recurring transfer, set recurring investments if the platform allows. Do not rely on motivation. Do not wait until the end of the month to see what is left. There is often nothing left. Pay the future first. If $35 per week is too much, start with 10. If 10 is too much, start with 5. The amount can increase later. The habit is the first victory. Once the habit exists, raises, bonuses, tax refunds, and spending cuts can increase it. The biggest mistake is waiting until the amount feels impressive. The amount does not need to be impressive to begin. The system needs to begin. Now, let us talk about the psychological pressure of comparing small investing to large goals. A person hears $942,000 and thinks, that is impossible. Then they hear $54,750 of contributions over 30 years and realize the out-of-pocket amount is not impossible for many people. It is the time and consistency that are difficult. $54,000 over 30 years is not one giant heroic act, it is $5 a day. The challenge is not only financial, it is behavioral. Can you do something small for 30 years? That is the question. Most people want intensity. Markets reward consistency. People want a breakthrough. Compounding rewards repetition. People want certainty. Investing rewards disciplined uncertainty. That is why so few people capture the full benefit. They know the math, they fail at the behavior. Now, what happens in the final decade of compounding? This is where the curve bends most. In the early years, the contributions dominate. In the middle years, returns begin to matter more. In the final years, the accumulated capital does much of the work. This is why quitting late can be so costly. A person who stops at year 10 misses the most powerful part. A person who stops at year 15 has done much of the hard work but has not reached the payoff phase. A person who stays for 30 years sees the full curve. The last decade often creates more wealth than the first 2 decades combined. That is the nature of exponential growth. But to get the last decade, you must survive the first 2. That is why patience is not passive. Patience is an active discipline. Now, let us think about inflation again. If groceries rose from $20 to $25.32, that is painful. But inflation also teaches the lesson that cash alone cannot be the long-term plan. Cash is necessary for emergencies. Cash gives liquidity. Cash protects against immediate disruption. But cash does not usually grow fast enough to build long-term wealth after inflation. If you hold every dollar in cash for decades, purchasing power may erode. That is why investing is not only about getting rich, it is about defending purchasing power. A portfolio of productive assets can be one way to fight the long-term erosion of money. Companies can raise prices, they can earn profits, they can innovate, they can distribute dividends, they can grow earnings. Cash cannot do that. This is why the paycheck alone is vulnerable. The paycheck buys less if wages lag inflation. The portfolio can give exposure to assets that may grow with or above inflation over long periods. Again, no guarantee, but a rational defense. Now, let us address fear of crashes. Every crash feels different in the moment. People always say, this time is different. Sometimes the cause is different, but the emotional pattern is similar. Fear rises, investors sell, headlines become dramatic, people pause contributions, then eventually, markets recover if the underlying system remains productive. The disciplined weekly investor benefits from crashes in a way the emotional investor does not, because the disciplined investor keeps buying. Lower prices mean more shares. More shares mean more future dividends and growth if recovery occurs. This is why the market's volatility can become your ally if you have time, diversification, and discipline. But if you need the money soon, volatility is not your ally. That is why time horizon matters. The $35 per week strategy is for long-term accumulation. It is not for rent money. It is not for emergency reserves. It is not for money needed next year. Long-term money can ride volatility. Short-term money should be protected. Each dollar needs a job. Now let us think about what $8,000 per month really means. $8,000 per month in projected dividends sounds like a job replacement. But it comes after 30 years in the source example. It requires reinvestment. It requires staying invested. It requires the portfolio assumptions to hold close enough over time. It requires not selling during crashes. It requires not stopping contributions because the early years look boring. That is the price. The beauty is that the weekly commitment is small. The challenge is that the time commitment is large. Most people underestimate the value of time and overestimate the value of intensity. But in compounding, time is the multiplier. A small habit given enough time can outperform a large burst done too late. Now suppose someone says, I do not have 30 years. Then the levers change. You can contribute more. You can increase income. You can reduce expenses. You can use tax-advantaged accounts. You can invest more aggressively if appropriate. Though risk rises, you can adjust goals. But the principle remains: consistent ownership of productive assets is still important. If you start later, the habit must be larger or the expectation must be lower. There is no magic. There are only levers. Time, contribution size, return fees, taxes, behavior, risk. These are the variables. A good investor works on the variables he can control. Now let us close the argument. The reason money disappears faster than it should is that the cost of life compounds against you. Food rises, debt costs rise, wages lag, cash loses purchasing power. The reason $35 per week matters is that it creates a compounding force on your side. It is not about the size of the first deposit. It is about the system the deposit belongs to, a well-designed Fidelity index portfolio. Using broad market exposure, mid-cap growth, sustainability exposure, growth and income, dividend growth, low fees, reinvestment, and consistency can become a powerful long-term machine. The source projection shows $5 per Dalton Y becoming $54,750 of contributions over 30 years and potentially growing into $942,000 with about $98,000 per year in dividend income. That is the story, not a promise. A demonstration of compounding. The deeper lesson is that your paycheck and your portfolio play different roles. Your paycheck funds life today. Your portfolio can build freedom tomorrow. If every dollar is consumed, the paycheck remains your only engine. If some dollars are converted into assets every week, you begin building a second engine. At first, that engine is small, then it grows. Eventually, it can become stronger than the first one. That is why the small weekly habit matters. Not because it looks impressive now. Because if repeated long enough, it can become something your future self will hardly believe came from such a small beginning. So the question is not, can $35 change my life this week? It cannot. The better question is, what happens if I turn $35 into ownership every week for decades? That question changes everything.